On the surface, the US-India relationship has never looked more robust. Bilateral goods and services trade reached $212.3 billion in 2024. A February 2026 interim framework reduced tariffs from 50% to 18%. The 18th Defense Policy Group meeting produced commitments on co-development and co-production of military hardware. The United States describes India as a partner of continental scale, whose decisions will profoundly shape the Indo-Pacific. But beneath these headlines, a structural trust deficit persists, and it matters directly for capital allocation. The fracture point was August 2025. The United States imposed an effective 50% tariff on Indian goods, a 25% reciprocal duty, combined with a 25% punitive surcharge linked to India's continued purchase of Russian crude oil. A Center for a New American Security, CNAS, report published in March 2026 documents the damage precisely. The tariff episode placed India among the most heavily penalized US trade partners, inflicting real economic pain on export-dependent sectors. Textiles, gems, leather and marine products, together constituting over 55% of India's $87 billion goods exports to the US, and critically intersected with political friction over the May 2025 India-Pakistan conflict and renewed American engagement with Islamabad. The Stimson Center's assessment adds a second layer. The tariff crisis accelerated India's instinct to diversify partnerships. The parallel EU Free Trade Agreement negotiations, the EFTA deal signed in 2024 with $100 billion of European investment commitment, and intensified engagement with Gulf economies through bilateral investment treaties. These are all downstream consequences of a single lesson New Delhi absorbed. Overdependence on any single partner, including the United States, creates unacceptable vulnerability. Pakistan's repositioning complicates the picture further. The CNAS report observes that Islamabad made more of the 2025 wedge between Washington and New Delhi than any other nation, demonstrating readiness on counter-terrorism, critical minerals, and Iran policy, precisely the areas where the Trump administration sought cooperation. For Indian strategic planners, American engagement with Pakistan is not merely a diplomatic irritant. It is a risk variable that directly affects the reliability of technology transfer, intelligence sharing, and defense supply commitments. China's opportunism compounds the complexity. The Stimson Center notes that Beijing seized the tariff crisis to push for normalization of relations, with India casting itself as aligned against American trade aggression. The partial border disengagement at the line of actual control, initiated in late 2024, provided the diplomatic opening. For institutional investors, the implication is that India's strategic calculus is triangular, not bilateral. Every US-India variable is mediated by China-India dynamics and, increasingly, by Pakistan's role as a swing actor. The technology corridor provides the clearest test of whether trust translates into tangible outcomes. The Initiative on Critical and Emerging Technology, iCET, and the Trust Framework have institutionalized collaboration across semiconductors, AI, and biotechnology. US technology investments in India run into tens of billions of dollars. Google's AI investments, L and T General Atomics drone collaboration, and ongoing iCET workstreams on quantum computing and space. India produces a significant share of global data, hosts 20% of the world's chip design workforce, and is building domestic manufacturing capacity through ISM 2.0.
We will launch ISM 2.0 to produce equipment and materials, design full-stack Indian IP, and fortify supply chains.
For Washington, integrating India into trusted supply chains serves both economic and strategic goals. Yet the CNAS report explicitly warns, a partnership cannot be sustained on alignment alone. It requires credibility and consistency. What does India see when it looks at this landscape? It sees a partner whose trade policy shifted from 3.3% average applied tariffs to 50% punitive duties within months, driven by domestic political calculations. It sees a $500 billion commitment that could reshape its import profile, but also constrain fiscal autonomy. It sees technology cooperation frameworks that are genuinely productive but contingent on political alignment that has proven fragile, and it sees alternative partnerships with Europe, the Gulf, Japan, and selectively with China that offer diversification without the same conditionality. For sovereign wealth funds and pension allocators evaluating India, the trust deficit is not a reason to avoid the market. It is a reason to understand the hedging behavior embedded in Indian policy. India is simultaneously deepening US defense integration, building European partnerships, maintaining energy access through Iranian diplomatic channels, and keeping a China normalization track alive. This is not indecision, it is multi-alignment as risk management. The investment case for India does not depend on the US-India relationship succeeding in isolation. It depends on India's ability to extract value from multiple partnerships simultaneously without being captured by any single one. That capability, strategic autonomy under conditions of deep interdependence, is what separates India from most emerging market peers. It is also what makes the India thesis genuinely complex rather than merely promising. The trust deficit will not be resolved by a single trade deal or defense agreement. It will be resolved, if at all, by a sustained pattern of consistent behavior on both sides. Until then, prudent allocators should price Indian assets on the assumption that the relationship will be productive but volatile, and that India will continue to build optionality into every strategic commitment it makes.